All right, I think I've got a very good lesson for everyone today. And we're going to talk about what is the best strategy to be trading in a market crash. Since it seems like we're in the midst of one now, what is that best strategy? Should we be longing? Should we be shorting? Should we be hedging? Should we be in cash on the sidelines? Now that last one is what a lot of people, you're going to hear a lot of people tell you that's what you should do. You know, when the market gets frothy, or they worry about the government, or the economic policies of the world. A lot of people say, I step out of the market because I'm worried about the future and I'm putting all my money in cash and I'm on the sidelines. Well, I'm going to tell you right now, that is the last thing and the absolute worst thing that you can do if you really want to make a lot of money. Now, if you're just peddling around with the market, you're a hobbyist, fine, you can do that. But if you're someone who's trying to make money at the market, that's the absolute worst thing that you can do. Number one, it's absolutely impossible for anybody, even the smartest human beings, the greatest traders of all time in the history of the world since this market has been open, has never been able to time it to perfection. So number one, you won't be able to time it. So just forget about doing that. The second thing, which is even the bigger reason, is you are squandering the very greatest opportunities that you will ever see when it comes to trading stocks. Now, you may disagree with that, but I'm going to tell you this right now. These are few and far between events when you get situations like you see right now in the market where you get this absolute huge retracement in the market of 7 to 10% in just a couple of days, or just individual stocks when they crash or they go through these serious corrections. These are the type of opportunities that make people legendary type of money. And if you want to be prosperous in this business, you got to know how to do that and you got to understand. Now, that old stock market adage has always been, don't catch the falling knife. Well, you're not trying to catch a falling knife. You're only catching a falling knife when you don't know what the hell you're doing. It's better for you to wait for the knife to just fall to the ground, then go ahead and pick it up. Again, you may disagree with this, but I'm going to walk you through a couple of examples. And I'm going to show you, because one of the misconceptions as well is that when the market flushes or when you go through these big corrections, that the very best thing to do is short. When in fact, I found out through my trading experience, that's also incorrect. It's much easier to short stocks in a bull market, believe it or not, than it is to be shorting them in bear markets. So when ranges get so exaggerated to the downside or so lopsided to one area in this kind of panic situation that you have, it's best to be looking to go the other direction. Now, I don't want to call it counter trend trading because we're going to do something different with that today. So what I'm going to do is I'm going to walk you first through this NVIDIA trade. I'm going to post it up here on the screen. These arrows on the chart show our entry price on this today and our exit price. So this is just the first trade out of the day, $7 gainer. Now this goes back to what I was saying earlier about squandering the best opportunities. Now normally something like an NVIDIA, this NVDA, may yield you $3 or $4 in the entire day. From the time that it starts till the time the day closes, you might get $4 of range on a good day. But you see how exaggerated these ranges get in these panic and euphoria situations. It allows you to have the ability to get these monstrous gains like $7, $10. I mean, it wasn't just on NVIDIA today. You had the same types of move in Netflix today, monstrous move there. You had the same type in Tesla. You had the same thing in the market itself. You had these humongous range shifts. Like, you're not going to get $7 every day of the week out of NVIDIA. That's why I keep telling you, this is why you need to understand and learn how to do it, because most days it'll be on a smaller level. But in situations like this, you don't want to be afraid. You want to step in there like a real man or woman and get business done. So let me talk to you about it. So let's go through this NVIDIA trade so I can show you how we approached it. And it will work for any stock. And I'll show you how it works against the market. And it's not rocket science. You've heard me say this before, that trading is all about levels. See, when people refer to catching a falling knife, that means they're guessing. They're not paying attention to a level. They're not managing risk in the trade. So you take those two elements out, yeah, you're catching a falling knife. But if you have your levels down, you have your risk down, you can really put yourself in position to make some serious money. Now, will every one of the trades work out? Hell no, they won't. But it's all about risk to reward, and this is where you're at. So let's go back to NVIDIA. I'm highlighting the bottom chart here. This is a daily time frame for those that are new. You know, these are candlesticks that are highlighting how much movement is in the daily. So when we just talked about range, you see how these candles work. And then all of a sudden here, the last 2 days, you get these really exaggerated moves to the downside. Now, the very best range detector, of course, is support and resistance. You're always going to hear me say that. So let's not look at today's green candle reversal. Let's just look at today's, the previous days right here, which would be Monday. Let's just go ahead and take a look at Monday's level. Now, what we're going to do is I'm just going to draw a line here, straight on out, as far as I can here for right now. Okay, and I'm going to highlight, just let me open this up just a little bit more, okay? So this is the very bottom of trading on Monday. We'll do the intraday right here. So very bottom of trading on Monday. You see you get this huge exaggerated wick, which drops from 217 all the way down to 205, and you get this instant snapback. Now what this tells you is that this bottom area right here of 204, we'll just say 205. We don't have to be spot on with our money. But 205 tells you that this is the first piece of interest since this thing started deteriorating from the 230s. This is the first point that buyers really got aggressive and really stepped in. So what this move signifies is a capitulation of early longs, long-term longs that are stopping out, and buyers finally stepping in and picking this thing up. And they all meet at this place of 205. That's why you get this erratic shift in the stock's price. Now, if you missed that trade, the next day that we're here, which is for, Tuesday, we're looking for another trade on this. We're looking to re-long this position. And the first thing we want to do is look at that level. Since it bounced, we want to take a look at that 205 area and see how much interest. So there's 2 trade ideas that we have this morning on it. One, you get 205, you get a hold of the 205 area, and this stock should stand a pretty good chance of bouncing. If it doesn't, and you open, let's say you open up to a market flush, plan B, market gaps down, there's even more panic on top of this, where will the stock go? Now, if you look at this price, this is also coinciding with January 3rd's price. That's the second day of the year of trading. You can see it lands right in there, almost to the penny, trades right into that level and then bounces. So the next level, you'd have to be looking at the close of the year throughout this consolidation, which is roughly about 195, 196, in that area. Again, you don't have to be perfect, but you have some sort of idea. So the 2 trades were, one, the market holds up. This establishes 205 as a support structure. We buy it, and that's our trade. Or the market flushes. What is our next level? What would be our next plan? Well, we'd be looking down at 195. Now, is this necessarily a buy at 200? Maybe. But you really want those longer levels because stocks have a tendency to trade from one level to the next. So if you're just buying anywhere from 205s, you're not dealing anything from under 205s to 195, that $10 span is not solid enough resistance. There's not enough solid of past supports in there. So they may not bounce as well. So those are the 2 levels we're looking at. Now let's move to when the market opens. So it starts out here. I'm going to just move this chart over because this is today's chart. And you see already in pre-market, this gray area is the pre-market. You can already see if you just do the 205 line draw again, you can see it's already tried to hold it. Now it did just perk right below that, but immediately comes right back. And as the pre-market was open, it just kept clinging on it. But there wasn't enough there yet to say, look, this thing's going to hold 205. We don't know. And then, of course, the first move you get out of the day is some selling. Let me try to just show you what the chart looks like. You get a nice shot down in here, and immediately, the very next bar, you see this thing starts to perk up. Now, as soon as it starts to perk up, just any kind of green that you start to get in there, the earlier you can get on a move like this, the better. Now, in a traditional market that's not flushing out, I would say wait for a 209.65 area break or something like that, where you can confirm the breakout. But in this case, our stops were just nestled right under that 205. So think about what you're doing here. It's the risk versus reward. It doesn't mean that the trade's going to work or not. It's just that you get into it, you have a risk, but the reward is so high in this case because the reward could be a $10 to $15 move on a stock that normally doesn't give it to you. So you're risking maybe, in a worst case scenario, $2 for the potential to get 10, 15, or who knows. Because once this thing breaks that level, you have nothing in its way till you get all the way up here to 220, and then you have these resistances at 226. So you have clean air, and if the market turns around or any of that, that just aids it. And you can see that's basically what it did. As soon as it started perking, that was our long stop, and there you go. It trades right into that area. Again, no surprise that it peters out at 225 because that's the area. Now, you could have shorted it into resistance if that's the trade angle that you're looking at. But the point is, what makes people afraid to participate in markets like this is because they don't know what they're doing. They're guessing. If you're not guessing and you have risk in place, like on something like this, again, it may not have worked. Big deal. You lose $2, you know, then maybe it trades back down to another level. You can try it again. But you have risk managed, and you have this risk to reward ratio that's normally a 3-to-1. In a case like this, it's like a 10-to-1. You've got to go with something like that. And you'll see it did the same thing in the market. It's not just this stock in general. It's the same thing. You saw it with the market doing the same thing here early. See how it holds its pre-market levels, builds a triple bottom. All these levels do is give you an idea, where in the hell are buyers? Like when your stock is dumping and you're in it, you say, where in the hell are buyers? This is what you're looking for. You're looking for levels to be established, not just one bounce. You got 2 bounces, you got 3 bounces on this market right here. And as soon as it starts to go, at the 3rd attempt, why would it trade back? Now, certainly it could. We've seen all kinds of stuff in the market. But the chances of it trading back down there are so small. And again, you got, if you were looking at Dow futures, you got the same thing here. I'll pull up the YM. I mean, you got 23,645 to almost damn near a 800, 900 point move. I mean, just ridiculous amount of reward. And that's what I'm trying to say, guys. Sitting in cash and being on the sidelines, you don't score goals on the sidelines. I mean, you're in this business to make money. That's why you're here, right? And if you're not trading through these times, you are squandering the very best opportunity. I mean, maybe once in a year opportunity. It's been 400 plus days since the market's had a 5% correction. So you've had to go a year and a half almost before you've gotten anywhere near that. So this is what I'm talking about, how important something like this is. So, you know, take it for what it's worth, but you have to learn. And how do you learn? Support resistance. Look at your support. You know, think about where are the max value in the ranges in these trades? Where is the offering the value? Is it offering value to the downside? Is it offering value to the upside? In a situation when the market corrects 10% in a few days, the value is going to be to the other side. It's going to turn around, and that's where the big value is going to be. Look at those levels. Look at price. Price always pays. Price never lies. Look at where people are interested and take your shot. Use your stops. Again, if you don't do it, you're squandering great opportunities. I hope this made some sense. You ever need some help trading, you want to see this done? Visit thelincolnlist.com. Hope you learned something. Until next time, take care.